Hello, this is Daniel Want from Prerequisite Capital Management. Today we're going to quickly walk through this quarterly letter, particularly just focusing on explaining some of the charts that are included within it. Of course, this is just general information only and shouldn't be construed as specific advice. So the last few quarterly letters, we've kind of unfolded some basic first principles as to how the world works and what is unfolding at a broader context. This quarterly letter, we've decided to just quickly update more tactical conditions, mainly because we kind of see over-speculative conditions in many different markets. A common thread underpinning all of these over-speculative conditions is that the people and participants are pricing in growth and inflation expectations to be much greater than we believe is likely to be the case, at least over the next year or so. For example, so this first chart is the global stock market excluding the US, and it's a good summary chart where we can see this over-speculative condition. Similar times have marked previous sort of peaks. When we get this over-speculative condition and an underlying or a weak underlying liquidity situation, that typically, at least in recent times, has resulted in a fairly significant peak. So at a bare minimum, we're at higher risk in the world of global equity markets correcting or really having quite a swing lower over the next few quarters, if past recent experience is any guide. The thing is, this is just a summary chart. We see similar setups in most different markets. The general rule of thumb is that the growth and inflation expectations, sort of pricing in the world, or this reflationary bounce that we've seen in the last 9 months is quite excessive. And so a lot of these markets are vulnerable to rolling over. Looking at it from another perspective, we can see a lot of our sort of real economic activity leading indicators in the world are starting to show signs of stalling and potentially even rolling over. So this is one of them, one of our real economic activity barometers, once again presenting data sets excluding the US. We'll have a look at some US data sets soon. And this sort of reflationary cycle that we've seen, or sub-cycle, over the last 14 years or so is typically had a 2 to 4 year duration. We're starting to wonder, at least see signs that this sub-cycle frequency might actually be starting to speed up. There's a few different reasons for why this might be the case. Once again, PCS 56, we kind of go into this in extensive detail in a 50-page report explaining things. But this summarizes it well enough. And once again, you can see from the zoo surveys that we're kind of quite excessive and didn't take long to get back to a fairly optimistic stance in terms of growth expectations. So, like I say, that was just sort of a summary chart of a broader set of leading indicators that we're seeing. Looking at the US, however, so we've kept the same index from above in orange, but here we've overlaid real US GDP growth, but also the yield curve, 10-year minus 3-year, shown upside down just to better correlate with some sort of a notional economic cycle type concept. And then US corporate credit spreads, just the sentiment index that we are able to create from the speculative flows in corporate credit markets compared to US Treasury markets. And so here we can see over-optimistic conditions again, which typically correspond to more top-of-cycle conditions. Obviously, this is only just now starting to peak. However, we can see here whenever you start to get a significant steepening in the yield curve, typically that's ushering in some nearer-term weakness. This steepening that's persisting here is quite significant. It's more of a steepening that you kind of would expect, and especially some of our leading indicators on the yield curve are suggesting that this is more of a cyclical downturn in the US economy, kind of similar to these previous ones in the early 2000s and even 2007, 2008. So cyclically, we're still in a window of vulnerability in the US Short term, we've rallied quite a lot. We've obviously had that washout in US economic activity with the shutdowns in early 2020. And we've bounced out really strongly according to a multitude of measures. However, some of the higher frequency leading indicators are already sort of showing signs of stalling and turning over, both in the US and also around the world. And we've kind of had the sentiment and speculative money flows towards growth and reflation get quite extreme quite fast. And so this chart well summarizes sort of the likely top of sub-cycle conditions even in the US as well. Moving on, just quickly having a look at some of our inflation perspectives. So obviously we look at a variety of different things. This chart's a bit busy, but it kind of summarizes the predicament at the moment. So once again, over speculative conditions by a lot of different ways of looking at it. So this is the speculative money flows for global commodity markets, whereas down here in orange, the emerging market equities speculative flows. These tend to be quite well correlated to commodity cycles. At the moment, this is probably a bit of a relief rally, but also there's concerns around supply side concerns in commodity markets, and there's even indications of hoarding of industrial metals out in China from a strategic reserves sort of perspective. But largely the common thread in commodity markets and even a lot of the emerging market equities is that it's an over-speculative condition. A lot of this ramp up, very weak underlying liquidity, underlying fundamentals, or the real economic activity we've seen in previous charts is already sort of stalling and starting to roll over. Some of our better leading cyclical inflation indicators. So in this case, this is our sort of like a reverse engineered implied inflation expectations model. We discuss this in quite a bit of depth in PCS 27. It's effectively reverse engineering from capital markets, so interest rate markets and equity markets and different things, the implied break-even inflation expectations. And we've typically found at a cyclical level this leads commodity prices and is quite useful in terms of a cyclical leading indicator of broader inflationary conditions globally. At the moment, this bounce, although everyone's quite excessively optimistic around pricing inflation into, or inflation expectations into everything, it's still quite a muted bounce and a muted response. So typically the sort of patterning we're seeing here is that this bounce in commodity prices and inflation expectations generally is likely to be, or is more probable to prove, transitory as opposed to sustainable and persistent at the moment. Now, the reasons, there's a broader fundamental backdrop that is occurring, and especially with regards to what actually drives inflation in the world or within any given economic system. Obviously, that discussion is beyond just the quarterly letter that we're going through now, but you would need to see our more in-depth and detailed PCS reports to get the broader understanding of what actually drives inflation at a short, medium and longer term time horizon. Right now, for whatever it's worth, we see the latest bounce in inflation expectations as to likely prove transitory, which is kind of consistent with this sub-cycle potentially stalling out and possibly rolling over as 2021 unfolds. So moving on, we still have a situation where the broader global banking system is still structurally impaired. We've been discussing and writing about this for years. The last time everyone was excited about an inflationary or reflationary bounce, especially when things were getting quite fever pitched in late 2017, we were basically pointing out for a multitude of reasons, quite similar to today actually, that this bounce or this reflationary bounce is likely to prove transitory. So late 17, we were seeing a similar setup of stalling global economic activity over optimistic conditions. And so it seems like that sub-cycle is peaking again, albeit a little bit faster and earlier than the 2 to 4 year cycle would previously have inferred. So it seems like the same sort of setup again today, with issues in the banking system from a variety of ways of looking at it. Here, obviously, we just point out, and it's a bit more of a loaded discussion, but there's no coincidence that velocity deteriorated in early 2014 in the global banking system. And later in that year, we started to see the beginnings of negative yielding bonds in the world. And so that the problematic situation with velocity continues today. So once again, we are of the view that history seems to be repeating itself again. It's interesting that the US dollar couldn't even weaken beyond those early 2018 lows. So in the red here, it's the US dollar inverted. So this rising line actually means a weakening US dollar. And as you'll see in this next chart, the failure to be able for the US dollar to weaken beyond those early 2018 lows against a myriad of different currencies, and just in the black here, this is an equal weighted index that we've constructed using all of the major currencies that kind of matter in the world, and then the speculative flows of all of those currencies we've aggregated together. And we can see a situation here where price is only just getting back to early 2018 lows, but arguably the negative speculative condition is slightly exceeding those lows. And so anyway, this is quite a constructive. That would imply the US dollar has a lot more inherent strength under it than people are giving it credit for, especially on a multi-year basis. And with this sort of a backdrop, the next should the US dollar start to strengthen, we suspect it could be quite a surprise to a lot of participants, and it could be quite a move. Anyway, there's a variety of different things that we would highly recommend you review some of our recent quarterly letters, the last 2 or 3 in particular. That will give you quite an effective context as to this tactical setup. And so in our portfolios, we believe we're positioned actually quite well in light of the way markets are priced and the progressions that seem to be probable. However, our mandate is to be quite conservative and resilient. And so far, we've been performing exactly according to the objectives that we're set out to achieve. And we're fairly optimistic as to what lies ahead, particularly from a portfolio performance point of view. So hopefully this video has been helpful. Obviously, let us know if you have any questions. This has been Daniel Want from Prerequisite Capital Management.